Global X is bringing you a world of opportunity. Let us guide you through investment opportunities abroad with our range of international access funds. Explore innovative megatrends disrupting our economy and shaping the future with thematic ETFs focused on structural shifts in technology and demographics. Enhance portfolio potential with our wide range of income solutions, including bonds and alternative options-based strategies. Home to the world's first physical gold ETP, Global X offers Australia's largest range of physical commodity ETFs, as well as next-generation minerals and miners. We are also leaders in cryptocurrency, with Australia Pacific's first ever direct exposure Bitcoin and Ethereum ETFs. Feeling bullish or bearish, execute with our powerful leveraged and inverse trading tools. Global X is here to help you to construct a solid foundation and strengthen your core. With our diversified and innovative lineup spanning across asset classes, Global X's mission is to empower investors with unexplored and intelligent solutions. Simply put, we strive to offer investors something beyond ordinary.
So the whole motivation of this presentation is more to do with when you are looking outside of Australia, for example, US equities or even global equities, what should you be looking for? What are the things you should be concerned with? If you are looking at AI, if you are looking at technology or innovation, what are the things to look for? When you look at commodities, what to look for? So this is more about what are we supposed to be looking out for when we do invest outside of our so-called home turf. Now, for those who don't know, Global X is a global ETF issuer. We're headquartered in the US. We span multiple countries. Our parent company is Mirai Asset, which is one of the largest securities companies in Korea. And we've got over 170 billion in terms of assets. Australia-wise, we are growing very, very rapidly. We have about 46 ETFs issued in Australia right now, and we have over $12 billion in assets under management. Now, for today, like I said, there's a few things I want to go through, and it's sort of crosses multiple sectors, but the first thing is more about US allocation. And this is a really, really hot topic because everyone asks me, how should we allocate to US? Should we allocate to US? Should we even just decrease our allocation US? And I'm going to address a few questions there. I'm also going to talk about beyond US. When we look about investing outside of Australia but not US, what are the opportunities? And what should we be looking for? Should we be more selective? Should we just be buying outright, country indices? What are the things we should be focused on? And then we'll talk more about AI, innovation, artificial intelligence. This is something of a hot topic. I'm sure all of you would know about NVIDIA. Some of you might know about Palantir. All these are great stocks which have done really, really well. I'm going to touch a little bit on commodities. And the reason why is because I think there's a misconception there now. Commodities used to be known as an inflation hedge, hedge against the dollar, hedge against geopolitics. But I think now there's more of a reason to look at commodities or precious metals for various reasons. And then finally, we'll go back to home turf and talk a little bit about how and why we should be also positioning ourselves in the Australian equities market. Now, when we talk about our US, the interesting thing is, and that sort of varies from institutional investors, it varies to wealth managers and individuals like yourself. The key question is, why look at US? US is facing a lot of different headlines, politics, geopolitics. We've seen tariff growth concerns. What are the things we should be concerned with by looking at US? And the first thing that comes to mind is everyone saying tariff is bad, and I agree with that. Tariff will have a negative impact on the US. And this is why people have been revising down the expectations of the US. People have been revising down. So if you think about at the start of this year, analysts or the market were expecting the US market to grow at about 2.2% in terms of GDP or economic growth. That has actually been revised down to about 1.5% right now. So there has been a major revision downwards in terms of economic growth outlook in the US. But the key is this chart. Even despite all the downgrades, even despite all the growth concerns about US growth, which is denoted in the black bar, is still expected to grow at a faster rate than the G7 economies. it is still going to be one of the fastest growing, if not the fastest growing, developed economies in the world. So I'm not even talking about US having, depth of liquidity, depth of credit, innovation, talent, whatever you call it. There is very, very strong case to hold US because it's still, one of the fastest growing or strongest growing economic powers in the world. Okay? And this is obviously compared to the orange bar, which is the average of the G7. Next 3 years, 2025, 26, 27, it is still expected to grow faster. Now, the next question I usually get is, okay, Billy, US growth is good. It's one of the fastest growing developed economies. We're fine with that. We know that. But like the previous speaker was saying, there's a valuation issue, right? There's a valuation. It's gone up so much, all-time highs. Is it expensive? Should we still be holding it? Should we be selling it? Should we be buying more? And the key to look at is valuation metric, and a popular one is the price earnings. So what are you paying for earnings growth? Price over the earnings growth. So when you look at the PE ratio, which is this chart denoted in orange line, the PE ratio for the last 20 to 25 years, it has squiggled around. The first thing to note from this chart is A, right now we are at about 22 to 23 times price earnings or PE ratio for the S&P 500 or for the US market. The first thing to note is that we're not as high as back when during the dot-com bubble. Okay, obviously, it's not the best comparison, but the key to note is we are at all-time high in terms of equities, in terms of level, but we are not at all-time highs for valuation. Okay, it has gone up in the last 4 years, but we haven't gone back to the dot-com bubble times. The second thing from this chart, and more importantly, is actually the shaded area in blue or light blue. The shaded area denotes the average operating margins or the average margins of the US companies listed in the S&P 500. And what we see there is in the last 25 years, the operating margins of US companies have consistently gone up from an average of about 11% to right now about 15%. And this is the underlying crux of why people like US, why there is a US exceptionalism. It's because US companies are getting more productive, more efficient, innovation, AI, whatever it is, in the last 25 years. The justification of a higher valuation for US is because exactly they're now much more productive. Margins have gone up and margins continue to go up. And this is one of the few markets, if not the only developed market, that is seeing much more productive or improvement in margins. And this is the key. Margin means sustainable growth. Margins means sustainable cash flow. Margins means much more stronger company. And this is exactly one of the key reasons behind so-called US exceptionalism. Now, the counter argument is, look, Billy, there's always downside risk, right? Things don't always go up. You've talked about upside risk. What is the downside risk? People might have miscalculated. Maybe the earnings are going to go down. Growth could be much lower than expected. My view or our view is that the risk is actually the upside risk. We could potentially see much better than expected growth than what market is forecasting. And the reason is I believe that the market is actually overestimating the impact of tariffs. Like I said, tariff is bad. I'm a very fundamental, old school analyst. Tariffs are going to be bad for the economy. But there could be actually buffers to what the tariffs could impact. And I'm going to show you the next chart, which might seem a little complicated, but we'll walk through it. What I've done in this waterfall chart is to make some assumptions about the possible impact of tariff to the US economy. And that's exactly what that big black bar in the first part shows. US imports about $3.5 trillion in imports every year. And if you assume that the Trump administration ends up with the 30% universal tariff, that means about $800 to $900 billion of US dollars of impact to the economy. This is negative for the economy, positive for the US Treasury, negative for the US economy. But that's not the end of the story. The first thing is there is going to be a buffer from the exporters. So these are the companies from Asia, Vietnam, China, whatever, that want to maintain that relationship, that want to maintain the scale, and they're going to give some price concessions or price discounts to the US importers in order to actually maintain that. So the exporters will take part of the tariff, will cushion, and that's the first orange bar. The second orange bar is actually the importers. US companies, in order to maintain competitive, will sacrifice some margins in order to maintain their competitiveness. And that's going to be a buffer and eat up some of the tariff impact. That is negative for the economy, but remember that previous chart, US companies are trading at one of the highest margins ever in history. They do have the buffer to lower margins or to actually sacrifice some margins. But I think the biggest mispricing, or what market is not looking at, is the third orange bar, which is the impact of the One Big Beautiful Bill Act, or OBBA. And look, whatever your view of Trump is, whatever your view of politics is, this act is going to be positive for the US economy. What the OBBA does is that it incentivizes US companies to push forward their investments in order to get tax reductions. So a company could be spending $10 billion in the next 10 years, and because under this act, they'll be like, no, let's spend about $6 in this year because we're going to get full tax reduction and we're going to get huge tax savings. And this is exactly what's happening. You see headlines like Google, Amazon, Facebook spending $30 billion in CapEx, or capital expenditure. And the reason is because they want to take advantage of this tax reduction. And the tax reduction means tax savings. Tax savings means additional capital to be deployed, which means that it's going to be positive for the economy. And this is what could also buffer or sustain the tariff impacts. So overall, I'm not saying that the tariff won't have an impact on the US. It will, but it just won't be as bad as what's expected. So my calculation shows about $900 billion of gross tariff burden initially, but with all these buffers, it might end up to about $150 billion. So this is where the potential upside for the US economy is. Now we've talked about US, but also we need to think about being much more selective. It's not just about, hey, US is great, there's upside, let's just buy US. And the reason for that is because if you look at this chart, which looks a little messy, but what this is called the S&P 500, or the US equity market dispersion ratio. What the dispersion ratio means is that on a daily basis, how much the winners are winning and how much the losers are losing, the difference between them. So if Google goes up 7% and it's a leader, and stock goes down 7%, the dispersion is 14%. And what this means when we see in the past 4 years, as dispersion has been very high, and what that means is that leaders have done continuously much better, and losers have been continually doing much worse, which means that we need to be selective. We need to be selective. It's not just about buying the US equity as a whole. We need to buy the winners. And obviously, the last 4 or 5 years, the dispersion comes from the Max 7, the FANGs, the NVIDIAs, because they've been doing so well, and they've been outperforming all the other laggards. And this is why it's been like that for the last 4 or 5 years. And our view is that this is going to continue. We're going to see winners winning more and losers continue to lose. And it's very, very important to be in the right theme, the right sector, and the winners there. Another thing I want to share is, even when you break down by sector, what this chart shows is the S&P 500 broken down by sectors. Energy, consumers, information technology, utilities. Orange bar shows the growth in terms of earnings, and the black bar shows the return on equity. So what this shows is that when you even break down the US equity market, we see winners and losers. Some sectors are growing faster, some sectors has a higher quality or higher return on equity, and this makes it even more important to be focused on the winners. It's not just about buying the whole marquee or like simple index. We need to be focused on the right sector. Now, what about going outside of US? US is good. US should be part of your core portfolio. But now really think about what we get outside of US. And what this chart shows is the earnings growth for 2025, 2026, 2027, those are 3 black bars, for each major country, including US, Europe, UK, Germany, Australia as well. What I'm trying to show here is that US is still growing well, 8 to 12% in the next few years, but we're seeing other countries where their corporates are still growing as fast, if not faster, than US companies. And this is important because now we're seeing higher growth or attractive growth outside of US. But again, what about valuation, right? It's all about valuation. It's all about what you get for bang for buck. And how I look at valuation is something I call the PEG, or the price earnings growth ratio. What I mean by that is I use the price earnings, which is that valuation methodology we always like, divided by the earnings growth for the next few years. And when you look at this ratio, the US is trading at a PEG ratio of 1.8 times, but we also see other areas trading at a lower or more attractive PEG ratio, such as Germany, even parts of Asia. Now, what that means is that growth is coming outside of US, but also we're going to get better bang for buck when we do other areas or when we invest in other areas as well. And this is important. US is still doing well, but think about where there's better bang for buck outside. And just bear in mind, even the Korean equities market, it's up 50% year to date. It's up 50% year to date. Now, we've talked about this sort of US and global part of your portfolio. Now, what about the growthy part? What about the innovation? What about the tech? And this is really exciting because not only me, but our firm believes strongly in artificial intelligence. And we believe that this should be one of your core parts of your portfolio, mainly because this is where you get growth. This is where you're going to get not just growth, but even quality as well. Now, whenever I talk about AI, the question is I get, like, look, Billy, we've talked about it. NVIDIA's gone up, 400, 600%. All these Meta, Google, they've gone up so much. Is AI over? So the first thing I did was I go, okay, if you think AI is over, let's think about the past innovations in history and think about how much they impacted or brought to the global economy. What this table shows is a few things: steam engine, electricity, information technology, what these three big innovations, how much they contributed additionally to global growth. So essentially, how much additional growth did this innovation bring during this period? And this ranges from anywhere between 15% to 30% additional global growth. Now, when you look at AI, and let's assume it started around 2022, 2023 when ChatGPT came out, it's only added about 1% of global growth. In addition, AI is just at the start. It's just happening right now. The value is going to come soon. When I show this chart, I always get the question of, look, Billy, it might be fake. AI might just be, it just might not work. It might not bring value to the economy, which is a fair point. And whenever I get that question, I always bring back this case study because this is exactly when I started becoming an analyst and I started looking at smartphones. Smartphone adoption started around 2005, 2006 when the first iPhones came out. And initially, people were concerned because the first apps or the first applications that came out for smartphones were Facebook, WhatsApp, and Instagram. But these didn't make money. These were just platforms with a lot of users. I think Facebook at that time had 1 billion users. And everyone was asking me, Billy, how can smartphone make money when they're not making any money from apps? They've got a lot of users. And this is exactly what's happening now in AI, right? Everyone's using ChatGPT. No one's really paying for it. Everyone's using all this AI. There's not really value coming from it. My view, or our view, is that we're waiting for the killer app. We need a killer application. We need a monetization or a commercialization of the innovation to create real value. What we saw during smartphone was that it was the new games, the applications, the Angry Birds, the Candy Crushes, these apps that really generated value, generated income, generated this monetization ability was the real actual value growth during that innovation. And this is what we're waiting for AI. And I think this is exactly what's happening now. We're seeing AI being applied to online advertising, media, even healthcare, even infrastructure, even logistics. It is right now being monetized. There are actually robotic humanoid robots being used in China factories to build cars right now. And the 70 seconds, just a factory with all robots building cars and churning them out. It's being monetized right now. And the value is going to come in the next decade or next 2 decades. And we're going to see this very, very soon. Just to give everyone a good idea or some case studies. The first one is this chart, which again, a little messy, but very straightforward. This shows the operating margins. This shows the operating margins of all the online advertising companies, Facebook, Google, Snapchat. What we've seen in the last 3 years since the advent of artificial intelligence was that their operating margins continuously to grow. And this is because AI or innovation has helped them do cost savings. Another case study I look at is a media company. I get asked why Netflix is always considered an artificial intelligence company. People watch Netflix, but they don't realize there's algorithms in place that's using AI, but they don't also realize that Netflix is using AI to actually produce films. And why that's important is because when you break down the cost of a film production, about 47% of a traditional film production is talent, your movie stars, your Tom Cruises, your Russell Crowes. But also, a large remainder of the cost of a traditional film are things that can actually be helped or even replaced by AI. Settings, locations, VFX, lighting, post-production. This all adds up to over 50% of a traditional film. And this is where AI comes in. And this is exactly what companies like Disney and also Netflix are doing. They're using artificial intelligence to make their media much more cheaper. So if you have a time, look at the Netflix, look at the Disney quarterly earnings report, and you'll realize that their cost has actually come down significantly in the past 3 years. And this is exactly why. It's because they're using AI in order to produce their films and content. Now, is it just about US? Is it just about the NVIDIAs, the Facebooks, the Googles? What about outside of US? And this is when I go, there's also innovation coming outside of US. And I want to talk a little bit about China because, look, I was working in China, Hong Kong for about 15 years, and I know a lot about the innovation that's going on there. And the key question is, Billy, look, it's hard to make money in the Chinese equities market. The market goes like this, up and down, and it ends up at 0%. But the thing about the Chinese equity market is that when you invest in China, you're not investing for the economy. The Chinese economy is 60% SMEs, and they're not listed, which means that when you invest in the Chinese stock market, you're not investing in the economy. To make money, to benefit from the Chinese equity market, you need to look at policies. China is a planned economy. The 80s, infrastructure. The 90s, it was manufacturing. And then we got digital infrastructure. You invest in the policies, not the economy. And so what we see in the next decade or next 2 decades is that China is going to invest heavily in innovation. Semiconductors, robotics, EVs, and AI. These are 4 of the key innovation investments that China is going to do, and they're committed. And the question I get is, look, these are just policies, Billy. Look, President Xi, the president could just change it right now. They could just stop the investment right now. But my view is that he won't do it. China cannot stop innovation. China cannot stop investing in productivity. And the reason is because it's not just about productivity. They're doing it to survive. China's major problem is this. China's major problem is the aging population. By 2050, over a third of the Chinese population will be over the age of 60. They're trying to invest in productivity in order to solve the aging population problem. They don't want to end up like Japan during the 1980s when it was an industrial powerhouse, lost productivity, and that's where they lost all that edge. China is trying to solve this problem, which I think means that they're going to invest in innovation, productivity, efficiency for the next 3 decades at least. And this is where you want to be. If you want to be investing in policies backed by the government, it will be innovation in China. Now, just to sort of give a really sort of holistic view of how I look at the AI market, we have this whole big value chain within AI. We have hardware, which is the semiconductors. We have infrastructure, which is the data center. And we also have the adopters. These are the 3 key areas in artificial intelligence which I look at. And we've talked about it. We've talked about semiconductors, robotics. We've talked about data needed. And we've also looked at which companies are using it. Netflix, Meta, all of them are using AI. And it's really important to sort of realize that there is 3 segments as well. Now let's touch a little bit on precious metals. And like I said, people look at precious metals and think about inflation to hedge, hedging inflation, hedging the US dollar, or even geopolitical hedging. But it's more than that right now. And the key reason is 2 things. The first thing is that there is now an additional demand for gold or additional demand for precious metals. And that's coming from ETFs. The more money that goes into ETFs or exchange traded funds, the more demand for gold because these funds have to buy gold. So what they see in this chart, which is the orange line, which is the more important one, is all the cumulative flows or the cumulative money that's going into global physical gold ETFs. It's been on the rise for the last 20 years. Gold ETFs is one of the largest ETF segment right now in the world. And what that means is that the more gold that's being purchased by ETFs, the more money that's going in, they have to buy more gold, and that's creating additional demand. So it's like a vicious cycle. Okay. Obviously, it goes both ways, but we're seeing this going much more faster now. The second new or additional demand is this chart. This chart looks very messy, but it shows the quarterly breakdown of what people are buying gold for or where the demand comes from. There's only two colors that you need to look at. The black bar, which is how much physical gold people are buying in gold bars, people buying their coins, and they keep it under the bed. But the more important part is the orange bar. This is where the demand from central banks are coming from. As you can see, for the past 4 years, the central bank purchasing or the contribution from central bank buying gold has been increasing, has been one of the largest demand. And this is not just Chinese central bank or Indian central banks buying it. It's global central banks buying more and more gold. I'm not going to go down to what reason it is, but there is now more central banks buying it, including European banks, Latin American banks, and also South African central banks. They're all buying more and more precious gold or precious metals. Another thing to sort of to look at is that it's not just about gold. There's actually a lot of precious metals which are very similar in quality and behavior to gold. When you look at the year-to-date performance, gold has done really well, over 30% or close to 30%. But you also look at palladium, platinum, and silver, which has actually outperformed gold as well. And this is interesting because they are all actually interrelated. When you look at the bigger scheme of things, yes, we have gold, but there's also a relationship between gold and silver. People look at it as from a trading perspective. There's a ratio between those two. People also look at platinum and palladium because it's a replacement for gold. These are all interrelated. So when we look at gold, when we look at precious metals, it's an entire basket. It's not just about buying gold. There could be times when gold is expensive and you could buy silver. You could also be buying palladium. You could just buy the whole basket. They are all interrelated. And now finally, just coming back to home turf, we've talked about US, we've talked about global, we've talked about AI, we've talked about commodities. Does that mean we shouldn't be holding our Aussie equities? We should still hold our Aussie equities. And the reason is this. This chart shows the breakdown of the ASX 200 or the Aussie equities in terms of sector. What we see in the left-hand side is the ASX 200 has a large composition of obviously banks, financials. About 33% of the ASX 200 are banks by weight. We've also obviously got the next one, which is materials and energy. Australian equities market is dominated by banks, financials, and also materials and energy. Now we need that because if we only invest in the US, which is the right-hand bar, which is S&P 500, you only get the IT, information technology, you get industrials, you get healthcare. So the importance of holding Aussie equities is about the complementary benefits of holding all the sectors in order to diversify. Have your US to get that tech exposure, but also have your Australian equities to get the exposure to financials and also materials. Two more benefits of holding Australian equities is more of a technical perspective. The first one is that, look, it gives you yield. It gives you better yield. What this chart shows on the orange bar is the average dividend yield of Australian companies compared to the lower two bars, which is overall the world companies paying dividends and also the US companies paying dividend yields. What we can see in the past 15 years is that Australian companies have on average been paying a higher dividend yield than all the other countries as well. So it's important to look at Aussie equities. And obviously you get the franking credit benefit as well. Another thing to look at is actually volatility. Australian equities are less volatile than the US counterparts, or even when you compare it to world as well. Australian equities are more comfort of mind. And these are two key reasons why it's also important to have Australian equities. Now I'm running out of time, so let's quickly wrap up now. The first thing to really look at is US. US exceptionalism still holds, okay? US growth is still there, still one of the fastest growing developed economies, and we could get upside potentially from Trump's policy. Look for selectivity. It's not just about, just buying all US. Look for growth, look for value, and look for sectors. AI is important. We are just at the start of artificial intelligence. There's so much possibility and monetization and also commercialization abilities. rethink your commodity sleeve. Commodity is not just your small inflation hedge anymore. They're now key drivers or new drivers to commodities. And finally, use your Australian equity portfolio or your segment to actually be a complement in terms of risk, in terms of dividend yield, and in terms of complementing different segments. So thank you for listening through my presentation. And of course, if you have any questions, Global X has a booth outside. We've got two good-looking boys out there, Caleb and David, that's happy to talk to you through our products. But thank you.